The CoinDesk Spotlight is brought to you by Nexo, the place to earn on Bitcoin, Ethereum, and more.
Algorithmic stablecoin UST's $14 billion collapse has sent ripples across the stablecoin market. Tether temporarily lost its $1 peg, dipping to 96 cents according to CoinDesk data. Algorithmic stablecoin Neutrino USD also slipped below its USD dollar peg. Joining us now is Mike Coscetta, Chief Revenue Officer at stablecoin developer and issuer Paxos. Hi there, Mike. Thanks for joining us. Paxos issues the USDP, Paxos Standard stablecoin. It's not algorithmic, it's collateralized. But I wonder, is there any impact from the UST Luna collapse?
Well, first of all, good morning, and thank you for having me. It's really great to be here. And we love the opportunity to share our view on the markets and our view on what stablecoins are and should be. And Paxos has taken a stance from a very early stage that the stablecoin should be stable, that it should be backed, it should be regulated, it should be transparent. And when you start to see a proliferation in the market of stablecoins that call themselves that, and that's clearly not what they are, and now you have very, very stark evidence and some terrible stories associated with what happens when stablecoins become casinos and games. You see a lot of ripples around the market. And we are at least of the stance that this may, in the long run, be exactly what the industry needs to clean out and clear out, some of the non-stable elements of the business, and to get people back to knowing what stablecoin is. A dollar should be a dollar.
Mike, you talk about some of the clearing that needs to happen in the business, even with collateralized stablecoins. We have a big differentiation between certain stablecoins that show mostly cash and cash equivalents on their balance sheet and easily redeemable, compared to others which may have mostly commercial paper, illiquid assets on their balance sheet. Does this okay? Let's stop beating around the bush. Tether, and we saw Tether's price go below $1. It briefly, and then it shot back up. Are we going to see more of this? Are we going to see more of this market concern and skepticism about these stablecoins that are collateralized but not collateralized with liquid assets?
Yeah, I think, anytime you see a market take a hit and you look at all the red on all these charts, it's nice to see some green today and some stability in some places we haven't seen it. But there's always a reverberation effect, and it takes the market a little bit of time to recover, and it gives the market a chance to really assess what should be moving forward. You mentioned things backed, but coins backed mostly by cash. Mostly is a really dangerous word. Mostly does not mean cash. It means mostly cash. And when things go wrong, those percentages really start to matter. And, again, it's our belief, and I believe the belief of the regulators and our governments that, the stable coins should be backed 100% by cash and cash equivalents, so that if people do need the money and they need to withdraw, they need to liquidate, there's no risk, there's no delay, there's no slippage. It's a dollar. A dollar in is a dollar out. If it's not a dollar. And to call it that, I think, is just a really dangerous thing for the industry and for the market. And we're looking forward to seeing this as an opportunity to really ensure that stable coins are operated the right way. Algorithms can be gamed, algorithms can be changed. Backing things with mostly cash is great when things are great. And when things start to weaken a little bit, you really start to see them collapse. And, we saw this in 07, 08 with the traditional financial markets. You're seeing it now, with some of these coins, and, hopefully we can get past this soon, and really move on to really the future of stable coins, which should be, again, a fully reserve backed, regulated, transparent, model.
Just want to, explain to the viewers the importance of stable coins compared to cryptocurrencies. A lot of investors, traders trade in and out of volatile Bitcoin positions or other crypto positions in order to get into stable coins if they want to, eliminate that possibility of volatility, and they just want to enter into a stable currency for a while as the market volatility eases up. And so stablecoins are just more easier to access than a US dollar, because then you'd have to go through all these fees to exit an exchange into US dollar. Rather than that, you could just use a stablecoin because it's native to the crypto world. Just want to ask you, but can algorithmic stablecoins work, or they just don't, and they should always be collateralized?
I mean, I think the second you call it an algorithmic stablecoin, you've stopped calling it a stablecoin. There's nothing stable in many of these cases about how those algorithms are based, because the assets underlying them that's shifting the reserves generally are not stable themselves. I think what consumers want is they want certainty. What regulators want is they want transparency. And you put these two things together, and you have the forward-looking, ability to turn a stablecoin into a very ubiquitous, very high utility asset. If the value of that asset underlying is constantly shifting, well, then it looks less like a stablecoin. It may be an investment. It may be an amazing investment. It may be a great store of value for certain cases, but that doesn't make it a stablecoin. And I think really the ubiquity and the utility of stablecoins will come from when they're all pegged the same way, they're all reserve backed the same way, and when those reserves can be audited and transparently seen by anyone involved. So again, I know if I'm going to put my life savings into something as a savings, that I'm going to be able to pull it out anytime I need, that it's truly my money, it's truly liquid, it's truly accessible, and I don't have to worry about all these different market conditions to line up, for me to be able to have my money there. Doesn't mean there's not a place for investments and upside and to the moon mentality of many crypto assets. I mean, that's why we're all here. The industry has gone through enough winters, but also enough summers, that there's a future for any type of coin with any type of backing. But again, I don't think those algorithmic coins should be called stable coins.
So going forward, of course, stable coins are the backbone or at least an integral part of DeFi. And what do you think that means in terms of the growth of the DeFi market with the lack of of algorithmic stablecoins? I know you don't like that expression, but nonetheless, that's what we have here. When UST was particularly popular on DeFi, USDC is popular as well. Do you think that what's DeFi going to look like now? Are we going to see lower rates because there'll be more of a demand for asset-backed, for collateralized stablecoins, or do you think that we might, see an implosion of the market? What's that future look like to you?
I would go back to a few very basic economic principles that, despite crypto being a brand new industry and with a ton of new innovation, a lot of the same economic factors still come to play. Number one, there's no free lunch. So when you see 18, 19, 20% returns, those generally have to be coming from someplace that's likely unsustainable. So I think you're going to see, I don't want to say collapse, but you'll probably see a deterioration in many of those types of programs. The second thing is when you look at the proliferation of DeFi protocols and DeFi tokens and all the different innovation around decentralized workflow and decentralized processes, I love what that means for the future. And I think there's a giant opportunity, for innovation in all decentralized aspects of work. However, I think, again, when you see a new industry pop up, sometimes there's opportunism and sometimes there are things that look great and may be great for a very short time under certain market conditions, but in the long run really just don't make sense. So what this does to me, this gives the industry a chance to really figure out what are the long-term protocols, what are the long-term DeFi workflows that make sense. How do you properly incentivize and reward people for participating in those decentralized economies? And I think many of them will go away. I just think it's inevitable. And I think out of that, many new ones will pop up, and you'll see a different level of rigor put around what it takes to be a global, ubiquitous, DeFi asset, DeFi protocol, DeFi workflow. And that's where I think the long-term innovation will come in the market. So again, I think there's an opportunity that comes out of this, as rough as the past, short term has been. I think, again, you'll start to see a cleaning of this industry and the DeFi aspects, really start to clarify which ones are viable and which ones were, maybe just a short-term opportunity.
Yeah. Michael, I just want to maybe address, what the appeal of UST was for many folks in the Terra Luna ecosystem. And that was, this idea that it was this decentralized algorithmic stablecoin that wasn't beholden to any entity. In the end, it was neither decentralized nor algorithmic. It wasn't even a stablecoin, but nevertheless, that was the idea that was pitched to them. And so they didn't, they didn't feel that a centralized stablecoin like a Tether, like a USDC, like a Paxos that was backed by, fully backed by the US dollar and controlled by a centralized or a private entity that was making sure that the collateral was there was adequate for the DeFi space, for the crypto world, because anytime some sort of government could go in and potentially seize those assets or close down accounts. So they really wanted this decentralized stablecoin. And so I wonder what you would say to those folks.
Yeah, I think there's a future for decentralization all over the board. I think I understand and see the desire for decentralization from a governance standpoint, from a freedom and kind of liberty standpoint, and from a transparency standpoint as well. The only thing I would say is that the vast majority of the world is still operating in the confines of a very traditional financial system and a very traditional legal system. And to operate in those systems and with those customers and with those partners, very often you have to abide by some aspect of regulation, transparency, audit, or some aspect of affirmation, and whether that be KYC, KYT, and all the things that all financial institutions have to do to prove and to show that this money is moving properly, safely, securely, and legally. And that is the vast majority of money moving around the world today. So is there a future for a decentralized access to money in a global, transparent way? There probably is. But again, I think to call it a stablecoin was problem number one. To back it in a way that wasn't potentially sustainable is problem number two, because if anything, it actually just draws more scrutiny against the ability to do this in a decentralized way in the future versus having done it in a, relatively pegged or stable way, from the beginning. Not to say that our own dollar, doesn't have its own problems with 8% inflation and supply chain issues and all the other things that I think draw natural scrutiny, to the idea of pegging to a dollar. But I think at least in the short term and the medium term, the way to go is going to be to continue to build financial instruments in a way that people understand, that they know, that regulators understand and know. That's to me where the real mass adoption and the broad adoption comes from.
So I do want to get to your latest foray into Brazil with Nubank, but before we do, this issue is a very important issue in Europe, and Europe is looking at potentially banning certain stablecoins if they get too big. What's your take on that? And it seems to have extra impetus now with this, with the collapse of UST. What's your take on what the regulators in Europe want to do, and then also too, as you advance in Brazil, what is that structure like? What's going on there, and what's the general approach?
Sure. A few different things in your question, obviously. I don't know the details of what the EU is going to propose. I mean, the EU has a hard time getting alignment and getting clarity among its member countries to really do any form of broad legislation around financial instruments, but we'll see. I think, again, what should come out of this is that the EU, the US government, whoever, sees that there's a place for private stablecoins, but that they have to abide by a certain set of open rules and a certain set of regulations that make it safe and secure for the end user, for the institution, for the partner bank, for whoever's going to be touching this, to feel confident and safe that this money, is secure. And I think that's a win for everyone. Waiting for the European, central bank and authorities or the US government to go issue its own coin in its place, I think is going to be, quite a long time in the making. When you look at Brazil, and you mentioned Brazil, what you see there is a craving for access to stability and a craving for access to the financial system in a way that, digital infrastructure makes it a more inclusive environment. And, you look at the newest launch we have with Nubank, they have 53 million users. They don't have a single bank location in their entire, infrastructure. Their infrastructure is purely digital. And it now gives all those users the ability to buy and sell Bitcoin and Ethereum. We've seen, long history in Brazil of looking for access to US dollars. In Brazil and other Latin American countries, sometimes the only way to get access to dollars is through digital means, through a stablecoin. And, we're happy to be the provider for Mercado Libre. We're happy to be the provider for PayPal, and of course, USDP and Binance as well. And we think there's a lot more demand that'll come for stablecoins in a region like Latin and Central America, where there has been so much financial and economic instability for many, many, many decades.